Hello, everyone. Welcome to the panel of the market trend of real estate investment in the United States. So today we invite two panel speakers. One is Dr. Ling He and another is Daren Blomquist. And welcome both of you, and thank you so much for coming. And it's always a pleasure to have you. And so first of all, I will start with a brief introduction to the both panelists. So Dr. Ling He is an expert in distressed real estate investment. Since 2008, he has purchased hundreds of non-performing mortgages and real estate in foreclosure, bankruptcy, and probate. In recent years, Dr. He has been focusing more on distressed investment and luxury residential real estate development in Southern California. And so this is our first speaker. And the second one, Daren, is the vice president and market economist of Auction.com. His main area is analyzing and forecasting complex macro and micro data to guide the investors and consumers for the real estate investments and purchases. So welcome again. Okay, so since this panel is about real estate investment, so let's start with a question about what do you think about the current market of real estate in the United States? As we all know, currently right now is very hot. Like, my neighbor sold his condo with 26 offers. And so what do you see? What do you think about it? Yeah, so let's start with Dr. Ling first.
Okay, thanks, Chris. I would think I would defer to Daren because he's our expert in big picture data.
Sure. Hi, Daren, could you please first?
Yeah, I think I do, it's hard to describe the market right now, but I would describe the market as overheated. But it's overheated for good reasons, for fundamentally sound reasons in a sense. And so it's not, even though it's overheated, it's not as risky of a market to get involved in, from my opinion, as it might have been, say, 10 years ago when we were seeing some of the similar signs where there were home prices were going up by double-digit percentages. And actually more than 10 years ago, back in 2005, 2006, when we saw some of the similar market conditions. But this time around, what's driving this overheated market is more fundamentally sound. And so from a buyer perspective or an investor perspective, it's not as risky to get involved in this market, to buy in this market. But if you're looking for, if you're the type of investor who's looking for discounted assets or distressed assets, which we do at Auction.com, those are definitely harder to find in this this type of marketplace. And a lot of the investors we know who used our platform last time around, especially the big institutional investors, are pulling back in this market and saying, "Hey, look, this is too much for us. We're going to sit on the sidelines for a little bit while we wait for the market to calm down and be more selective about the properties that we're purchasing." They're still purchasing, but just be more selective. So that's some initial thoughts about where I see the market right now. And I would love to hear Lynn's perspective from the front lines as well.
I see. So Dr. Ling He, are you agree with what Daren saying? What do you think about the economic drives and factors behind this thing right now?
I'm not as an expert as Daren in terms of market data. I know Daren, he always has a lot of chart to show. Maybe he can show us more on that. But from my perspective, as an active investor, I like to engage in the market no matter what the condition is. But there are different ways of doing that, which I'll get later. But what I see in the market right now, just like everybody else, is so crazy. What I can add to it is that even the luxury market, even the super luxury market, which typically is slower just because of smaller audience there, is very, very hot as well. I'm helping a friend buying a house somewhere between 10 to 20 million range right here in Newport Beach. We have seen about 10, 15, 20 houses. Pretty much all of them went into escrow within a couple months, which is pretty extraordinary. And I think I just set a record, possibly, I don't know, but it's up there. I have another friend, they just bought a house for $6,000 per square foot, which is a huge number. So the overall market, it's people, still see a lot of liquidity there. And the same thing, people didn't have to sell. People are selling now. It's like, I have another friend. I mean, he said, hey, if you can get it, my house got a $15 million, I'll sell it tomorrow. I just want to catch you on the top, what he perceives the top of the market. So all kind of buyers and sellers out there, right? Most people say, I would think Daren may agree, is because it's a lack of supply and the extreme imbalance between supply and demand. I have agents friends tell me that, several of them tell me, I've been in the business 30 years, 40 years. I've never seen anything so off balance in terms of supply and demand. And that's a big deal, of course. And with all the liquidity, all the low interest rate, I mean, everybody's seeing the same thing. But yeah, that's what I'm seeing in the market.
So do you think that compared to a few years ago, actually during this special time, that the luxury market actually going up because of lower interest rate, or because we know that a lot of people actually probably lost their jobs? Maybe that's not the potential buyer for luxury, but could you elaborate a little more about this, maybe the target customers or the potential, trend for this submarket?
In terms of luxury market, I think it's kind of interesting. Obviously, it's affected by interest rate, like the big macroeconomic environment, right? But also a lot to do with the confidence of the business community. If they have the money, it's just a matter of they're willing to open the wallet. And obviously they are, and the price are, I'm an agent tell me, Lane, I think buyers just lost their mind. I mean, it's going crazy, even on the luxury market. I personally know that a person I know extremely well, his house used to be like $1,500 per square foot. All of a sudden, almost like overnight, in a matter of months, the neighborhood is selling for over $2,000 per square foot. That's like over 20% jump. So I'm seeing that the increase in terms of price, but on the other hand, you're gonna have really good product out there. Newer homes, like the Newport Coast, newer homes in Crystal Cove are selling very well, but the older homes, all those Mediterranean style homes in the 20 years old, even those 5 million, 10 million, 20 million, is still sitting there. So there's just such a difference. But if the pricing is right, it's moving.
Oh, that's great. And so it seems like from both your perspectives that we have a very, kind of overheating market. But based on what Daren said earlier, that you think that it's actually have a sound drives behind. So do you guys think that we have a price bubble in the foreseeable future, or do you think that the future gonna continue going up and gonna be stabilized by itself? Yeah, we start with maybe Daren.
Sure. Yeah, I think that's something I get asked a lot and is out there a lot. And I don't think we're in a bubble in the sense that we have a higher risk of seeing home prices crash in the near future. However, I think the best case scenario, and I think it's a pretty likely scenario, is that we will see in the somewhat near future, maybe the second half of this year into the beginning of 2022, we will see home price appreciation slow down. It won't go negative, but we will see the market cool down in a sense, as potentially inflationary pressures put upward pressure on mortgage rates, which then slow down demand a little bit. And I think, and affordability, even without interest rates going up, affordability is starting to become an issue. One of the reasons that demand has been so strong is at the beginning of this year and in the second half of last year, the price, even though prices of homes were going up, your monthly payment on a home was going down because interest rates had gone down so much. But now we've started to see that shift. And so I do think the most likely scenario going over the next 6 months to 12 months is that home price appreciation will slow down. You'll see a little bit of cooling of demand, but you won't see a bubble popping scenario. Now, how I would say that the reverse of that is, or not the reverse, but a possible alternative scenario to that is that if we do continue to see prices go up by 15 to 20%, which is what the National Association of Realtors numbers are showing on median priced homes. If we see that continue for the next 6 months, like we've seen for the last 6 to 8 months, then we will be starting to worry about a home price bubble. And so we're kind of at an important milestone where if the market starts to cool down, I actually think that's a good thing. You know, some investors who are counting on continued appreciation of 15 to 20% might get caught off guard, but I don't think we'll see that going forward over the next 6 to 12 months, and that will be good for most people involved in the housing market because what we've been seeing over the last year is really not sustainable for the long term.
I see. How about, what do you think, Dr. He?
I generally in agreement with Daren. That's the big picture. What I'm counting on is hopefully it's going to be slowed down in the next maybe 24 months. Stress a little more because I have 2 projects in to finish. But generally speaking, I don't count on 20%. I don't count on any appreciation. I do count on the market wouldn't drop by 20%. So typically, when I get into a deal, I always ask myself the question: am I going to lose money? Would I lose money if the market dropped 20% at 6 months? I don't see that happening. So I have a margin of safety, hopefully next 12 to 24 months. And like Daren said, another factor is that the siting season will be behind us in this couple of months. Will naturally slow down. And then next spring, who knows? You know, let's pray, I guess, put it that way. but I generally speaking, I think it's gonna. I'm guessing it's gonna be have some kind of appreciation. May not be 20%, but who knows? Really depends on, you know. But a lot of people are thinking the current inflation pressure is transitory, right? So in other words, maybe by end of the year, it might slow down a little bit. Then the Fed won't need to, increase the interest rate. That will help. But generally speaking, I think this time could be a normal, quote unquote, normal real estate market cycle, because in the histories, people can go back as far as the data. We have data. The 2008 is the only real estate crash that the tail wagged the dog, meaning that the real estate market pulled down the housing market, pulled down the general economy. Typically, it's the other way around. You know, typically the housing market is like 6 to 12 months behind the general economy and in reaction to the general economy. So I would just watch where the economy goes and inflation goes and go from there and to be prepared either way.
Yeah, okay. And Dr. He, I will continue the question for you because you are very specialized in distressed market. So what do you think about the distressed investment, and what are the risks and opportunities out there?
Well, regardless of the market condition, life goes on, right? People still, born or die, life happens, right? Divorce, lost job, so on and so forth. So generally speaking, it's nothing like 2008, 2009, but there's still opportunities out there. That give you a perfect example. I mean, I got a deal end of January. It's because an investor who got into bankruptcy, and he got like 20, 30 houses, right? So I pick up one of them from bankruptcy court. I was going to buy the note. I was going to buy the junior note. And then that didn't work out. I just keep changing strategy. Whatever you want to do. I joke about it. It's from Blackstone. So I joke with the asset manager. I said, whatever you do, I'm here for you. So eventually I bought the property as off-market REO. So the deal is still out there, right? You can see how probate it's still there. So, but you're gonna be a little careful with the specific products that you're getting into. Like for this deal, I got a very significant discount, I put it this way. So even the market dropped by 20%, it's still going to be easily profitable deal, right? But I am cautious about what market is giving us right now. So I would just be really, really careful. And there's several things, I don't know, I should get into here right now, but I guess the big picture is just roll with the market. When the market is high and the future is uncertain, you're going to figure out ways that, tail I won, head I won, tail I don't lose, right? Just be careful. Don't lose money. You can choose doing different, put it back this way. I see people can wear 3 different hats to play the real estate market. First, you can be a equity holder. In other words, you can be holding real estate, be a landlord or flipper, whatever you want to do, right? And the second, you can be a debt holder, meaning a lender. You can lend money to people, that kind of thing. And the third will be the service provider. You can be an agent, mortgage broker, builder. Obviously, these 3 types have different risk profiles and returns, right? So in the market here, personally, I am leaning towards doing the second, the third. I don't know. I just kind of, okay. I guess I just make an announcement. So I'm starting a hard money loan fund. It's not because that's how profitable it is. It's because it's a defensive nature, meaning that because the loan to value is low. So I make a little bit of money, right? I don't want to get into the deal, get to another flip just for the heck of it, right? So I'd rather be defensive. And another thing is I'm doing right now for years, I've been not staying away, but having actively pursuing is to finally use my broker license of over 10 years, right? If you can help a friend buy a $20 million property, it's worth it. So you can play different kind of games. I think that's a big picture. There's certain other strategies I can get into later on specifically for that, but I'm sure Daren has something to say as well.
Yeah, hi Darren. So I have seen the PowerPoint you provided earlier, and I saw there are a couple slides about foreclosure and forbearance. So I know a lot of banks actually during the COVID time providing accommodated terms to the borrowers to help them pass this special situation, such as like extending the interest only payment period or restructuring terms to make it favorable to borrowers. So, but we are hopefully we are approaching the end of the pandemic. So do you think that all this credit risk gonna be flow to the surface eventually and actually will affect the economy in a negative way?
Well, I do think there is a backlog of distress in the market that has been held back because of these accommodative measures that you're talking about, and the forbearance and the foreclosure moratorium would be included in that. However, I wouldn't say that when we look at the numbers, which is very important to us because the Auction.com platform specifically is for distressed properties. For foreclosures and bank-owned properties. And when we look at the numbers, we're not seeing a massive wave of foreclosures. And I'll put some numbers around this in a second, but we're not seeing anything at the scale of what we saw back in 2008, 2009. However, that said, there is this backlog of inventory that we do expect to be coming to the market. And probably at the beginning of 2022 is when we're expecting to see that flow increase back to pre-pandemic levels. But to put some numbers around this, there's about 2.1 million mortgages, residential mortgages that are in forbearance, and meaning that most of them have not been making their monthly mortgage payments, or most of the homeowners. And so but because they're in forbearance, the bank is not proceeding with any foreclosure. There's about 1.8 million of those that are scheduled, the forbearance is scheduled to expire by September. And expire for the last time. So these folks in forbearance, they can get extensions up to 18 months. But folks who are hitting that end of that 18 months, there's about 1.8 million of them hitting that by the end of September. So the path for those mortgages is some of them will start flowing into foreclosure, a fairly small percentage. And then a bigger percentage will be flowing into loan modification or some other loss mitigation to try to help the homeowner get back on making their payments. But then another percentage of those will end up eventually either in foreclosure or as a distressed loan, which that's another opportunity for investors to buy those distressed non-performing loans. So that's kind of the big picture volume in terms of the flow that we're expecting. And when we put some numbers around that, we were expecting that there's a backlog of those roughly 2 million distressed mortgages. There's about 400 to 450,000 that we expect to actually end up going into foreclosure over probably the next year. And so that's, to put that in perspective, in 2020, we saw about 125,000 properties go into foreclosure, which people may be surprised at that there were any foreclosures happening, but there actually were foreclosures happening during the pandemic. But if you compare that 125,000 to maybe closer to 400 to 450,000, you are going to see more volume. In 2019, we saw about 200 to 250,000. That's kind of a normal foreclosure year. So all that to say, we are expecting to see elevated levels of foreclosure over the next 12 months. However, you know, back in the worst of the Great Recession in 2010, we saw over 1 million properties actually complete the foreclosure process. So we're still well below that level, but there is going to be more inventory and more opportunities in terms of distressed inventory for investors, we believe, over the next few months. And I do want to circle back to over the next 12 months. And I do want to circle back to the point that there are, even in this market, and Lynn kind of made this point, is that there are still opportunities even in this market to buy distress. It's maybe a little bit harder to find, but even on our platform, we're seeing foreclosure auctions happen and bank-owned auctions happen still during the pandemic. The parts of the country where we're seeing that happen are the most inventory is coming back in the southeast of the country, places like Georgia and Alabama and Tennessee and Indiana in the Rust Belt, and even Florida as well is where we're seeing some of the most volume. If we break that volume down by type of property, and this may not be surprising, but our platform deals with residential properties, and we're seeing residential foreclosures are at about 30% of year-ago levels or pre-pandemic levels. So they're still 70% below pre-pandemic levels, but they're still happening. However, if we look at commercial foreclosures, those are at 44% of year-ago levels, and specifically retail and office real estate, retail specifically, and this is probably not surprising, but retail foreclosures are at 73% of pre-pandemic levels. So those have come back faster. And so for investors who are looking beyond just residential, commercial is certainly a place where there's more distressed opportunities right now. And then finally, I just wanted to point out, when we look by loan type, the types of loans that are in most distress right now are the loans backed by the FHA, the Federal Housing Administration. And we're seeing that those are accounting for about 1/3 of all foreclosures right now, even though FHA is only about 15% of active loans. And so what that means is, and FHA loans tend to be low down payment loans and higher risk loans. And so those are the type of loans that are where we see the most opportunity for distress buying in this marketplace.
Thank you for sharing all this. As you mentioned, that there is an imbalance between different states, like geography, like category, and also in the property type categories, right? There is more in the office, retails, which we're all seeing, but less in the single family residence, stuff like that. So do you think that because with the when the economy is recovering, are this gonna be reversed? Or because we talk a lot about, we're all working home, we can work anywhere, and people get used to shopping online. Do you think that all this, on the big picture, micro level, are this gonna be reversed or maybe not?
No, I do think commercial will continue to struggle because some of the long-term impacts of the pandemic are going to kick in. Some of the stuff that you talked about, that a lot of the things that happened during the pandemic are going to go back to normal, so to speak. But I think we're going to see it more acceptable to work remotely for sure. And that's going to put pressure on the commercial market, the office, and specifically the office market. So I think we'll continue to see that pressure. Now, I do think on the residential side, the residential side is where we've seen the most government intervention to prevent foreclosures. And so that's where we will see, probably in the next 12 months, the biggest increase, because those have been the properties and the loans that have been held back the most. So we'll see the biggest increase, and it will, we're at 30% of pre-pandemic levels. Eventually, with the residential, I think we'll see that return to above pre-pandemic levels for a short period of time as that backlog of distress is worked through.
I see. Okay, and then so we talk about distress. Now we're going back to let's say regular market or general market. In today's audience, we have investors in different categories. Some investors are focused more on generating the rental income, recurring income from rental properties, and some of them are focused more on flipping and getting the capital gains. So for different types of investors, for both of you guys, what do you think about the the strategy or opportunities out there for different types of investors in these very uncertain times? So we can start with Dr. He, please.
All right. Sure. Thank you. I think a couple of things investors need to keep in mind. One is his or her own market assessment, right? So for me, again, it's, like you said, it's uncertain, it's hot. There may be some momentum keep going for the next 6 months, 12 months, 24 months, whatever, right? On the other hand, it could go the other way. That's the number one is market condition. Number two is your own situation. And when you do deals, when you're investing, so basically, big picture is use what you have to get what you want, right? So, you need to know what you want, right? You want to increase in equity to ride the market, or you want a stronger cash flow, because cash flow has been strong even with all this rent moratoriums, and or you might want tax benefits, right? You're a high income earner, you want a tax benefits, whatever you want. Now, work backwards. What kind of so what do you have to offer? Meaning that you have capital, you have expertise, you have knowledge, you have time. What do you have, right? But the general the market posture, I may not act like that way, but I think ideally makes sense because you have the market, is think what kind of property you want to get into, and what's your exit strategy? What if you have the 20% drop of the market? So it's a couple of specific things that I have in mind. Just generally speaking, it applies to different people for different scenarios, right? First, if you want to be on the equity side, right, you can buy apartments, for example, student housing, senior living, whatever, right? Those kind of things. It's not as much as like a high wire act, like I buy in a multi-million flip that can scare a lot of people, right? But if you find a fixed apartment, the worst case, you keep them, right? Nothing wrong with it, right? So that you keep the exit in mind. And or for people like who already have some rental property, some real estate, maybe it's a time to think to do a refi. Even the two things. One is to lock in today's long-term, ultra low interest rate, right? So you have a lot better cash flow from that regard. And two, you get the money out, do a cash out refi. You get the money, get the equity out of property. So now you have that liquidity, or use a fancy term called optionality, right? In other words, you have a dry powder to deal with the market when the wind shift. So another thing that the investor can do. And third, like Daren said, actually I go to Auction.com all the time. I'm on there. I subscribe to their emails. So I look for notes. I look for REOs. That's the source I go to all the time. And I look for non-performing notes there. And that's my favorite thing. So non-performing notes can be good. I have an investor friend told me recently that he said, those non-performing seconds I bought like 5 years ago, 10 years ago, I didn't have time to work on. Now people doing all this refi. So people call me all the time. Now I need to pay you off. And that's a very comfortable position to be, right? And even if you buy the note now, you can do the workout now or wait for later. Or like Daren says, you can go to Auction.com, find the notes that you can buy, right? Commercial or residential, right? And another thing, like say, Daren mentioned the FHA loans. Typically, they have like, very low down payment, right? But if you find right type, meaning that, in certain part of the country that you can get a pretty decent cash flow, then you could buy the property subject to those loans. That's how you scale your business, right? That's another strategy I would use. So in other words, a lot of people say, hey, if I already have 5 loans or 10 loans under my name, how can I buy more? That's another strategy you could use. There's risk to it, but we're not getting into that right now. But that's something that you can think about, right? And another thing I just mentioned is I talk about take the money out and the pounds on the opportunities, right? But what I get asked a lot is what I'm going to do with the money right now I have on hand. I always tell people, half jokingly, that keeping the powder dry, keeping money on hand and not quote unquote investing it is a sort of measurement of investors' maturity. If you have the temperament that you can hold on the cash for a while, could be the best thing to do. But I know it's a lot of it's pretty hard for a lot of people. So another thing, and frankly, that's why I started this hard money loan fund, was because people to park the money. You can learn, how, I'm not promoting my fund, but in general, you can invest into a hard money loan, lend money to the investor. You don't have to be the flipper if you feel, that's not something I don't have the time, have the knowledge, at a risk appetite to deal with flip. Hey, but you can be the lender. Like I said, you don't have to be the equity guy. You can be the debt guy, right? You can say, I loan him the money 8% or whatever, 10%, whatever. A few months later, you can't get your money back, right? So because you can underwrite a conservative way, rather than some hard money lenders right now do 90% purchase price plus 100% construction cost. You can do 80, you can do 70, whatever you feel comfortable, right? In this way, you can have decent return, keep your money busy, what's going on in the market, earn some decent return, right? And if you're even more aggressive, you can do, of course, you can always do a flip. You do 20%, do all sort of, probate, that kind of stuff, right? It really depends what do you have and what do you want, and have a multiple exit strategy will be tremendous help.
Yeah, thank you, Dr. He. I think the suggestion you give about switching the amount between different strategies as an equity investor or as a debt investor, or even as just a holder of the real estate. So I think that's a very good suggestions. And so, how about you, Daren? What do you think about strategies that you can suggest based on what you have seen from the data and the research and market that you can give to those investors in different categories?
Sure. Yeah, and I think Lynn's comments are really good about the diversification. We do see that, I would say that in this market, it favors home flipping as a strategy. Now that does require a kind of a ground game. You have to have people on the ground or yourself on the ground flipping the property, but we do see that as a good strategy, favorable as opposed to buy and hold, because the discounts are not as good. Number one, the discounts are not as good in this market, but price appreciation is great, so the home flipper can benefit from that. The other risk for buy and hold right now, and this may be more temporary, but is the fact that there's an eviction moratorium. So if you buy a property and get a renter in there, and this is also true for people who own properties, is you have that eviction moratorium where if they stop paying, you may not be able to get the person out very easily. And so that's a risk for the buy and hold strategy right now. And those two factors make it, we believe, make it more favorable for, or when I look at the data, I should say, make it more favorable for home flipping. And then that kind of third strategy is being the bank. We don't deal with as many investors who are doing that, but certainly I think that's a great option in this market too, because there are a lot of investors out there who want to flip but need the money to do that. And so being the bank for those folks is good. I did want to throw out, even if you are flipping, it's important to, and Lynn knows this really well, is it's still important to buy at a discount. So you do have that margin, even if the market doesn't go up as fast as you expected or even goes down. I mean, when I looked at public record data, home flippers who bought in, or who sold, who flipped in 2020, they had purchased on average at a 25% discount below the property's after repair value. And so they're building in, and a lot of investors I talk to would recommend an even deeper discount than 25%. But on average, that's what we're seeing is a 25% discount below the property's after repair value. And so that's an important piece of it. One of the things that we saw back in 2005 that got investors into trouble is they started buying at or above market value of these properties and just counting on the market to increase. And we still haven't seen that type of behavior with investors in this market, which I think is good. And it's important for them to remember. I did pull some numbers of people who bought on the Auction.com platform and then flipped the property, what kind of returns that they're getting. And nationwide, at least for 2020 and so far in 2021, on average, and I want to be careful about how I say these numbers, but on average, folks who bought a property and then rehabbed it and sold it, a flip, they sold it for $92,000 more than they bought it for. Now that's not including all the costs of rehab, but that was about a 58% higher than what they bought it for. And it took them about 279 days on average. So that's one thing to think about with flipping, is that you have to, especially with the properties that are purchased on our platform, they tend to be very highly distressed properties. And so it does take a long time and quite a bit of money to rehab those, but we are seeing some pretty good profits. The top markets with the biggest gains when home flipping were in Peoria, Illinois, Pittsburgh, Pennsylvania, Flint, Michigan, Springfield, Ohio, and Davenport, Iowa. So kind of in the middle of the country, and the Rust Belt is where we're seeing some of the biggest potential returns for home flipping. So that's what we're seeing in this market.
Thanks for sharing all the data. And since you are a market economist, so I was going to ask you a question about general economy. So we have seen a lot of positive indicators coming, like such as lower unemployment rate and a promising vaccination results. However, there are still a lot of risks or uncertainties around, like such as COVID breakout here and there, and we have a rising inflation expectations, and we have more strict monetary policy coming up, as well as uncertain global economy as a whole. So in this, has a lot of uncertainty times and has a lot of like risks. What do you think about the strategies or opportunities that you can give not only to investors but as consumers too?
Sure. Yeah, I think that we are seeing the economy roar back for the most part. Now, the difficult part that you've probably seen a lot of headlines about right now are that it's hard to find people to come back to work, even though we're still several million people short of what we were before the pandemic in terms of employment. It seems to be hard for companies to get people to come back to work. And so I think that's the challenge right now, is the supply of labor. And that's a risk factor and could be contributing to this inflation. I do see inflation as a risk factor. I mean, it is certainly, there's a good argument that the inflation is transitory in nature, but I do think if we're at a point where the Federal Reserve should probably start to pull back on some of their monetary policy that's stimulating the market in terms of quantitative easing, and even potentially looking down the road at raising the federal funds rate. And I think we're at a point where it's important for the Fed to start taking inflation seriously. And if they don't, then that could become much more of a risk factor next year. And so that's one piece of it. In terms of opportunities, I think that's a great question, and I haven't really thought bigger than the housing market too much about that. But I think there certainly are opportunities coming out of this. I think some of the things I would look at, and this relates to the housing market as well, but is demographics. Demographics is what is driving a lot of the housing demand that we're seeing right now. And there's two pieces of that, I think, that I think present opportunities for investors in the housing market and outside of it as well. And one is that we see the younger, under 35 age people much more interested now in becoming homeowners than they were before the pandemic. And so when we look at homeownership rates for that age 35 and under, that's up 12% from the trough back in 2016. That's the highest of any age group. So it seems like the pandemic was the thing that really triggered those younger homeowners, millennials, to decide that yes, homeownership is a good thing. And so I think that's a great opportunity. And there's a lot more of those folks who are becoming entering their prime homeownership years, which is in their 30s. And so that's a great opportunity there in general, is that demographic. And then the other piece of that is that demographic also, as well as other age groups, are, because of the shift to work from home, and I do think some companies are going to swing back toward trying to get their people to work in the office, but I think work from home will have a permanent impact. And because of that, what we're seeing in population, if you look at the latest census data, which goes through July of 2020, so it's not for the full pandemic, but we do see the places that people are moving well, first of all, they're moving away from places like coastal California, where Lynn and I are. That's where we're actually seeing net migration losses. People are migrating away from there more than people are moving to there. Coastal California, places like New York, on the East Coast are seeing net migration losses. And the places where people are moving are not, maybe not surprisingly, but places like Texas, Florida, Arizona, Nevada are some of the biggest increases in where people are moving. And so there's opportunity there. I think one place that I see in the data that people are moving that maybe gets overlooked a little bit is actually the Pacific Northwest, places like Idaho and even inland Oregon, inland Washington, away from the coast, and even Montana to a certain extent. So we're seeing those are the places in that a lot of these younger homeowners are moving, as well as older, and could I think we'll see we're already seeing economic booms in some of those markets, and I think we'll see that continue in those markets. And unfortunately, I don't think, coastal California is not doomed by any means. There's still a lot of people who want to live there, but we could see some of those coastal markets a little bit weaker going forward.
Yeah, as you said that, in the real estate market, in the short term, what drives the market is the supply and demand. But in the longer term, what drives is actually the macro drives, such as the population, immigration, stuff like this. So what do you think, Dr. He? Do you think that, these micro factors, like, we have a lot of changes since the pandemic. We have changed in our lifestyle, we have changed in our, working style, working habits. So what do you think about all these factors to play when you are doing the real estate investments?
Well, certainly it will have impact. And my answer may surprise you. As somebody in the trench doing deals, of course, I look at those big pictures, right, like data, but I defer those to experts like Daren. I get a big framework up there. I said, then that's as far as I go in terms of macro economy, right? What I focus on, as I've been telling investor, is once you have that backdrop economic outlook, the factor in, as an investor, excuse me, as a deal maker, you should focus on the micro for this particular deal. Does this deal stand on its own, regardless of what's going on in the world? And that's one cool thing about real estate deals is that I can go on forever, but it's really, especially you do flipping short-term stuff, there's not a whole lot direct impact on this particular deal. If the market is hot, then it's hot, then right, you just have more buyers when you're done with the flipping. It's a fact, right? So I always encourage investors to focus on the specifics of this deal and do not macro calls, big picture calls to interfere with your decision for this any particular deal. And I think that's really important.
Okay, great. Yeah, thanks, Dr. He and Daren. Thank you again for your time, and thanks for sharing with us about what your thoughts about the trends of real estate market in the United States and all the macro factors that gonna play a part in these investment strategies. So thank you again, and it's very nice to have you. Thank you.